In the past 7 years, I managed to build up an outstanding peer-to-peer portfolio worth 100,000 euro. This journey hasn't been an easy one though, as I made plenty of mistakes during this time and I have witnessed equally as many being made by other investors. For this reason, I want to talk about 7 common mistakes that investors do when investing in peer-to-peer lending, so you can stay clear of those moving forward in your investment journey. Greed is good has been a famous quote by Gordon Gekko in the Wall Street movie from 1987. My personal perception is a bit different though, as I believe too much greed will ultimately hinder us from achieving our long-term financial goals. And I can say so because I have been a victim of it in the past as well. Looking back to October 2017, I just started out with my peer-to-peer lending journey by depositing 2,000 euro with Bondora Portfolio Pro. Dazzled by the initial returns of up to 24%, I then deposited another 12,000 euro within the first 12 months. It was only after I wanted to consolidate my investment for some time that suddenly my return plummeted month by month. Although I have been able to withdraw all my initial investments by now, Bondora Portfolio Pro has been my worst peer-to-peer investment to date with a total return of only 1.39%. Most likely I would have suffered this poor performance either way, but the financial impact would have been significantly less hadn't I been blinded by my initial greed in the early days. It seems somewhat understandable that the outlook of high returns often triggers a certain gold digger mentality in us. Because after all, which investor would rather have loans with 8% interest rate in their portfolio instead of 14%? If you really think about it, the expected returns for peer-to-peer investments are often somewhere between not worth it and too good to be true. At the lower end of the spectrum, investors often ask themselves whether other asset classes with a lower risk profile might be a better choice for their money. This means that a certain competitiveness in terms of interest rates is already seen as a necessary element for a peer-to-peer investment to make sense. For this reason, many investors, including myself, have therefore established this seemingly magical limit of 10%, which is expected for an investment in peer-to-peer lending. Looking at the upper side of the return spectrum, past experience has shown that excessive interest rates are often considered as a warning sign, and rightly so. If we take a look at the list of failed or problematic peer-to-peer platforms, it contains usually companies that have promised above average returns, including the likes of Investio, Kutzal, Fast Invest, Crowdestor or Lender Market. In order for us investors to avoid this kind of mistake, it is important to carefully examine the platforms in advance and questioning their business model and risk profile. This is something that you can take a closer look at when reading through my in-depth platform reviews on the blog to recognize warning signals in advance. Cash drag has been a bigger topic in 2024 compared to previous years. Popular peer-to-peer platforms such as Peerberry, Robocash and Esketit have all struggled this year to provide a sufficient loan supply to meet the growing demand from investors. So at one point it obviously makes sense for investors to ask themselves for how much longer they want to keep their funds uninvested on a platform. In my personal case with Esketit, this point came after about 6 months this year. Looking at many other investors, their patience seems to be a lot shorter though. On one side, I can relate to them to an extent, but at the same time, I also don't fancy platform hopping, which is primarily based on loan supply. The platforms that I have mentioned are in such high demand because they have a strong portfolio quality and they didn't face any issues with repaying investors in recent years, which is why double-digit returns have been the ultimate consequence of it. If the price we need to pay for it is being a bit more patient at times or to select a few loans manually, then I would rather pick this approach instead of getting involved with less qualified platforms just for the sake of being fully invested. The geopolitical risk has become a lot more important in my personal lender selection in recent years. Looking at the war in Ukraine, a combined 137 million euros in war-effective investor funds were at risk via Mintos Peerberry, Twino and Debitum. While Peerberry was able to repay all outstanding liabilities almost 3 years later, Mintos has already suffered some losses, which appears to be the same fate on Debitum as well. For most of us, the war in Ukraine started somewhat surprising, including for myself. But if we are really honest here with ourselves, there have been phases of escalation many weeks beforehand, which would have allowed us to take action and to sell our Russian and Ukrainian assets. Looking at my personal accounts, my hesitance resulted in 1,000 euros being stuck in Russia via Twino and 300 euros being stuck in Ukraine via Debitum. Ever since, I asked myself whether the geopolitical risk is worth the expected return, which in most cases it isn't. My change in attitude has recently shown with my decision to sell my Vietnamese loans on Twino prior maturity at the end of 2023. About 6 months later, Twino announced that 2.8 million euro went into recovery while their lender prepared for insolvency. The same approach goes for my Jordan loans on Esketit, which have also been sold after the situation in the Middle East escalated further. Every investor is probably familiar with the Warren Buffett quote that you shouldn't put all your eggs in one basket. But did you know that he also said that wide diversification is only required when investors do not understand what they are doing? Concentration versus diversification has always been an underestimated topic, whereas my personal preference has always favored quality rather than quantity. For this reason, I decided a few months ago to temporarily pause my investments in FinTown and Profitus, even though I currently have no substantial arguments against these platforms. This approach not only focuses on the platforms itself, but also on the lender selection side. On Esketit, I rely exclusively on Avafin assets. On Mintos, I trust Esto, and on Inca Marketplace, I focus on lenders such as Danarupia, ITF, and Ibanka. My decision to take a more focused approach doesn't come without its problems. On one side, it requires a closer examination of platforms and lenders, while on the other side, even this approach can't guarantee to go right all the time. Personally, I still believe this strategy is the way to go, rather than calculating possible losses from the outset while maximizing diversification. Since this approach has served me quite well over the course of the last 7 years, I will now stick to this strategy for the time being. In addition to my last point, I want to add the tendency of investors to frequently rely on new peer-to-peer platforms. In general, a small track record and a lack of experience doesn't need to be the ultimate aspect that speaks against a platform. After all, German football manager Otto Rehhagel already knew that there are no young and old players, only good and bad ones. However, many peer-to-peer newcomers are often still underdeveloped, offer no real USP, and the risks are disproportionately high in relation to the potential return. For this reason, it is worth questioning whether a little more patience could pay off in the long run when the first meaningful results are available. And to close off this chapter, it is worth mentioning that Otto Rehhagel won the European Championship with Greece in 2004 by trusting the second oldest team in the tournament. In order for peer-to-peer platforms to grow, they must either focus on existing borrower countries or expand to new ones. Looking at the past, it has often been a better call for investors to not follow the expansion course of a platform. With more than 10 years of market experience, Estate Guru has always had a stable portfolio quality in its Estonian domestic market, despite having more troubles recently with a default rate of 14%. However, this seems to be a minor issue compared to the performance numbers in Germany, with currently more than 77 million euro of investor funds being in recovery. A few years ago, Estate Guru identified Germany as a core market for their expansion, and many investors, including myself, have blindly followed behind. Fortunately, this story has taught me a valuable lesson, which I was then able to apply when I was starting out with heavy finance. If we take a look at the platform's monthly performance reports, the loans from the Lithuanian domestic market have historically performed significantly better than the loans in Poland, for example. Accordingly, only 2 of my 40 outstanding loans from Lithuania are currently in recovery. This corresponds to a rate of 5%, which is significantly better than the platform average, with a default rate of roughly 20%. While supporting a platform in its growth plans can be admirable, it has rarely been a good decision for the overall return. Giving up too quickly and turning away from peer-to-peer lending is unfortunately another mistake that I observe more frequently in recent years. As it became evident in this video, there are a lot of pitfalls when it comes to peer-to-peer lending, and I have been personally affected by them several times. For me, these mistakes are a bittersweet, but also an inevitable part of the investing experience. From that perspective, I believe it's less about the mistakes itself, but what we can learn from them moving forward. No matter how bad my investment decisions have been at times and how much return they have cost me, in the end I always try to question myself. Why did I make this mistake, and what can I learn from it for my future investment decisions? So if there's only one takeaway from this video, it's to understand that mistakes are a necessary part of the process that will allow you to do better next time around. Thanks for watching until the end of this video. Now feel free to drop a comment below on the mistakes that you have done in the past when it comes to peer-to-peer lending, and if you agree or disagree with the points outlined in this video. Thanks for watching, and I catch you guys in the next one. So long. Bye bye.